Hello, good
Hello.
afternoon, everyone, and welcome to this new Startup Talk on the topic of Is Your Startup Fundable? My name is David Arias, founder of Strata and Startup Advisor, and I'm pleased to host this webinar that will last for 40 minutes. What are Strata Talks? So basically, they are webinars and short talks about innovation, startups, and deep tech funding. We've been doing these talks for about 2 years, and we have been focused on topics such as deep tech metrics, IP, intellectual property, technology readiness levels, funding, and specifically, we have also have discussions about different EIC, European Innovation Council programs. The recordings are available on fundedtrip.com, and this webinar as well will be recorded and available there. So the topic today is about fundable startups and readiness, funding readiness for startups. So yeah, investors look for specific signals that demonstrate that a startup is fundable and that it has potential to grow and it has scalability. And especially, they are interested to know if there's going to be a return on investment or ROI. And how can funders know whether they are truly ready to seek funding? And so this webinar is designed to help founders understand what makes a startup attractive to investors. And we will try to give actionable guidance and explain the key criteria investors use to evaluate opportunities, highlight common fundraising pitfalls, and share strategies to strengthen your investment case. As part of this session, we will also present how fundingtrip.com free assessment tool helps evaluate startups' funding readiness and identify the areas that need attention before approaching investors or even other funding programs or funding agencies. So yeah, whether you are preparing your first funding round or looking to improve your chances of securing investments, I hope this webinar will be useful for you. The agenda will start with Aracelia, Head of Life Sciences, who will present what investors really look for. Then I will continue by showing how fundedtrip.com readiness form and tool works for you in order to check your investment readiness. And finally, Martin Stanford, funding advisor, will give a couple of tips on how to strengthen the investment case, followed by Q&A. About me, my name is David Arias, founder of Strata, founder also of fundingtrip.com with 20 years or more of startup experience and more than 12 years of European funding experience with more than 100 million euro in non-dilutive funding secured for different startups and innovation projects. And about Strata, what we do is we empower tech startups to build effective fundraising and go-to-market strategy. We are especially focused on EIC and European programs, and we are a certified European Innovation Council partner, and we also support the code of conduct by the EIC. As part of our services, we are obviously focused on innovation funding, so facilitating funding for startups, especially non-dilutive funding, but also during the last few years, we also organize matchmaking and pitching events with investors, especially to complement non-dilutive funding with investor funding. We also provide innovation management services, IP, intellectual property strategy. We run IP workshops, and we do also patentability and FTO analysis for companies. And finally, market entry and growth. We can help companies also investigate and research markets and establish strategies and outreach campaigns to reach new clients or to enter into new markets. These are our main or our core capabilities in fundraising, innovation strategy, technology transfer, internationalization, investor negotiations, venturing, scaling companies, and business models. And our traction, we are a team of around 20 innovation consultants with clients spreading over 25 countries. And as I said, 100 million euro or more, actually much more now, acquired for startups and projects. And with successful projects funded by many European agencies. And we have also developed Funding Trip, which is a website portal with information about calls, European grants, and insights about investors. Is currently monitoring automatically all European funding calls, and it has currently opened 3,200 funding opportunities. It also provides a weekly newsletter that provides information about interesting funding programs at the European level, especially. And I'm handing over to Aracelia, who will continue with a presentation about what investors are really looking for.
Thank you, David. Right, so my name is Aracelia. I'm head of life sciences and IP strategy here at Strata. And for the next 10 minutes, I will walk you through something that most founders get it wrong. Not because you're not smart people, because it's not clear enough. So investors don't evaluate ideas, they evaluate fundability signals. And those are two very different things. Next one, please. So a little bit about myself. I mentioned my name, I'm Aracelia. So I'm a pharmaceutical chemist by training, and eventually I specialize in innovation management, and eventually further specialize in intellectual property management. I have been advising startups for over 10 years, and I also secure millions in funding for technology startups. Next one, please. So you're sitting at a table at a meeting with an investor sitting across of you, whether it's a 2-minute pitch or a full 10-minute, 15-minute pitch, and they're actually running a mental checklist. So it's not whether your product is good or your deck is beautiful. So they're not investing in your idea. They're investing in your ability to build a business around that idea. So that changes everything and how you should prepare for those meetings. So investors are assessing the risk and the return simultaneously. They're not just evaluating your product in isolation. They're looking into the whole system. You, your team, the market that you're going after, and the signals that tells them that this thing has momentum. So most founders show up features, but investors want to see fundability signals. And the four most that we have seen that matter the most are the team, the market and problem, the traction and validation, and the business model and scalability. And we will go through each one of them. Next one, please. Sorry. So at pre-seed and maybe at seed, investors are backing more founders than they're doing products. So the product will probably change, and more than once. So in this case, the team is the secure bet. But what are they looking for? So first is the domain expertise. Do you understand this problem better than everyone else? Maybe in this room, maybe in the city, or in the entire world. And it's not just technically, but also commercially, operationally, from the inside out. Do you know the problem? Do you know the pain points? The next one is coachability. So can you learn fast? Can you adapt? So investors don't really want founders who think they have all the answers. They want people who can ask the right questions. Also, there's resilience, because having a startup fundraising is hard, but building an actual company is much harder. So what is your actual track record under pressure? Do you have previous experience building something? That is important. Now it's how complementary the team is. So, does the founding team cover different areas in critical spaces? So, for example, you have a tech company, you need tech, but also you need to have business. You need to have different complementary skills. And one person can rarely cover them all. So, different people with different skill sets. Also, the commitment. Are you all in or part time? So part-time founders sometimes they don't inspire confidence, but they may be an answer to that. For example, it has happened to us many times in the past. You're a professor that is part-time in the university, but also part-time in the company. But once you secure funding, you're committed to transitioning full-time. So there can be explanations and also nuances to that part, but it's important that the commitment it is there. Next one, please. So the second point, investors don't really fund solutions. They fund what is the opportunity and the magnitude. So there could be a really nice product in a small market, but that's really a lifestyle business. It's not really a venture, a company. And that's not really criticism, but it's a reality that you need to understand when going to pitch for an investor, sorry. Investors want to see large addressable markets. So the TAM, the total addressable market, the SAM, the serviceable addressable market, and the SUM, the serviceable obtainable market. And a clear methodology and how you're presenting those numbers. So it's just not you have them up in the air. So you need to really explain and convey why are those numbers there. So also something that you really need to to convey is that there is a real problem, a painful one, and there is frequency in that. So it's just not a nice to have, it needs to be a real painful problem. Another thing that it's extremely good to pinpoint is the why now. So why now is a good time to have this product on the market? What has changed in the technology, in the regulation, or in the behavior, or in the market that is a good time and you can solve it now and not 10 years ago, or why we shouldn't wait 10 years from now to have that product in the market. Another thing, sorry, that is good to pinpoint is a defensible beachhead. So where you're starting, who is going to be your first customers, and why you're choosing them. So that's also important to take into account. But also we need to look at some red flags that sometimes founders give to the investors. So for example, saying our market is for everyone. Well, that's not a market. That's really a lack of focus. And you need to have focus if you want to succeed in the business. You don't have a competitive analysis. Well, that really tells the investors that you haven't looked or you're avoiding to finding out when you look at it. Other thing is you just pull numbers without sources. Also, that shows lack of profundization, so lack of information. And many times they will check the actual numbers of the market that you're saying. Also, not understanding why other projects similar to yours have failed. So that one is it's one that really worries investors, and not because all your projects fails. I mean, that is quite normal, but it signals again that you haven't done your homework. So you need to understand what you're doing differently that will make you succeed this time. Next time, please. Next one, please. Sorry. So the third one, that is traction and validation. Traction is the word that makes most first-time founders really anxious. Because for many of them, they think it means revenue, but it really doesn't, and not at pre-seed especially. So traction is the evidence that real people have a real problem and that your solution resonates with them. That's it. It's nothing more. So think of it as a ladder. So at the bottom, sorry, you have user interviews. For example, 20, 50 of honest conversations where people told you, not pushing them, that they have a problem that can cost them time, money, effort, something. The problem is costing them something. That is traction, not really revenue. On the second step of the ladder, you can maybe have an MVP or a prototype that real people have interacted with. And then on the following step, maybe it's early adopters, maybe a pilot, some users, a waiting list, or even letters of intent. And yes, at the very top of the ladder is the first revenue. I mean, obviously, cash is king, and even a small amount of revenue, recurring or one-time sales, can change dramatically a conversation with an investor. Next one, please. So, on our fourth point, so your business model and how scalable it is. So, here we have two distinct questions. Can you make money? And can you grow without you costing you proportionally more each time? So, on the business model side, we need to ask ourselves, well, the investors actually, they want to see a credible way to revenue, not a vague plan and how eventually you will monetize. No, a clear path on how you're going to earn money. Also, they want to see unit of economics and that they can work at scale because, again, the goal is for you to grow. And that also means how you're going to acquire customers and what's going to be the cost of that, and how eventually it's going to cost you lower, eventually, and the lifetime value of the customer. Also, something that is very important is a clear timeline. So having a vague timeline or vague milestones is a red flag. It means that you don't have a clear strategy. So we need to avoid that. Also, investors really prefer recurring revenue and high retention rates because that makes the business more predictable. And on the scale side, so this is when a lot of founders maybe they don't think big enough yet. So investors, they want to see a model that can grow without having high costs at the same rate. So it's not a linear thing. As you grow, cost should decrease because of volume. So can you serve 10 times customers without hiring 10 times more people? That is a question that they can think. Also, there are also network effects, platform effects, proprietary data. So can you handle those things as you grow? So think of scalability. Scalability, as yes, growing your business, but not growing in terms of resources that you need. So that's also very, very important. So investors don't want just a business that works, but they want one that can get significantly bigger without breaking or increasing the resources. Next one, please. So now we're going to tie it all together. So every time that you're in front of an investor, whether formal pitch or maybe at an event, you need to take into account these four things that they are thinking about. So are these the right founders to solve this problem in this market now? Is the problem large enough and painful enough to build a company around it? Is there evidence that real people want this before I even invest in it? And is there a defensible, scalable path to revenue? And what protects this path? So these are the questions, and the good news as we now know, as there are answers to them. So you don't need to be perfect for all of them, but you need to know where you stand on each one of them and be honest about the gaps. Now, in terms of honesty, David will now tell you how to do that with a tool that we have available. Thank you.
Thank you, Aracelia, for your presentation. So yeah, I'm gonna present a little bit more about the funding trip.com. As I said before, fundingtrip.com is a tool that helps founders search for opportunities, for funding opportunities, but it also includes an interesting tool that is the funding readiness self assessment. For founders, it also has a dashboard that helps founders qualify and do analysis of new ventures, and also get a startup deal flow from fundedtrip.com. So I'm gonna now show a little bit the platform, and especially focusing on the readiness funding readiness self-assessment. So I have to do this now. Stop sharing, and I'm gonna share another window. This one. Okay. Yeah, so if you go to fundedtrip.com, you will see this website in which you can search for funds. How does it work? First, you need to sign up. Then you need to enter some data about your company and yourself. You can then browse grants and funds, assess your profile, and follow and apply for different funds. On the top side of the website, you will see different options. So you have an option to find funds. Now it provides two different options. On the one hand, you have European grants, and on the other hand, you have equity funding. And each of these options will ask you for different questions in a very kind of easy user journey. To show you the relevant grants or the relevant funds for your company. Also, on the top menu, you have a blog. You have also access to courses. On courses, we have a fundraising course, which is right now in process, but we already have several courses that are available. The fundraising fundamentals, sweat equity and bootstrapping strategies, pre-seed and early validation funding will be soon released. We also have available a course on non-dilutive and supplementary funding sources, and soon you will find also two new courses on angel investment and seed funding, and on venture capital and growth funding. And if you on the panel, if you click on this link, you can create a new company. So if you create a new company, basically what you see is this form in which you can include information about your company. So when was it incorporated? What's the location? How many founders or employees you have, also some basic information about the economic traction, such as annual turnover, monthly recurring revenue. So these are basically basic indicators for investors, and in order to identify in relevant funding opportunities for your company, as well as for investors, identify relevant companies for them. And on the bottom of this page, there are two forms, two surveys, which actually are self-assessment tools for any founder to fill out. And the most important one is the funding readiness assessment. It includes it's very well aligned with what Aracelia presented before, but it includes also it's a little bit presented in a bit different way. It's divided into 6 different verticals, or 6 different areas: opportunity, market, proof of traction, scalability, team, and investment approach. So if you click on this button, What you have is a form in which there are a number of questions, and each question is then explained why this is important or relevant for the funding readiness of a business. And for each question, the founder needs to answer between choosing on a slide between 0 and 5. 5 is the highest score, so the closer you are to 5, the higher the score in regarding your funding readiness will be. No, so for instance, this question, our solution has something that nobody else has. It's new, it's better, and it's significantly different. It's kind of challenging the founder to think in a kind of humble way how different, how innovative his or her solution is. No, and this is more or less how all questions work. No, they are more or less challenging the founders to think objectively about their business. And there, if you look at the top menu, you have the different areas. So under opportunity, you obviously get questions about the opportunity, about your solution, about the uniqueness of what you're doing. Then if you go forward to market, the questions are obviously about the market, but not only about how the market looks like, but also about what's your readiness, the knowledge that you have about the market that you are entering, which is even more important for investors than the market itself, maybe in some cases. The third point is proof of traction. So here it's not only about sales, as Araceli said, it's also about conversations with customers. It's also about having POCs or having pilots with customers. It could also be about having a clear marketing and sales strategy, etc. So you have a number of questions here that are doing more or less the same as in the other areas. They challenge you to think about what's your reality right now, what's the real state of your company right now. Then we have scalability. So here the questions are more about what type of readiness the company has in order to scale. So it's about asking yourself questions about your IT tools, your IT systems, your automation platforms that you can use, etc. No. Then the next is about the team. So it has questions that can be a little bit surprising, like asking about the number of founders, etc. But this is actually critical for investors because they don't like, in general, solo founder startups. So you have to think as a founder objectively how prepared you are to ask for investment. If you are, let's say, the only one, or if the team is very small, no, that would be obviously a risk for investors, no. And the final part of this form is the investment approach. Now, and basically, what you need to describe here, or what you need to answer, is what type of funding steps you have taken in your company in order to attract customers. No, and obviously it's different for investors depending on what's your current stage, if it's just the first investment that you raise, or if you already have investors, or if the founders have or haven't put money into the company. And in the end, when you save it, you get a view, a general view of what's your readiness status. No, so in this case, the readiness, I just left many of the questions and answers, so it's quite low. No, it's 2.8. And then we also have this other form, which is called alignment survey. And this is a little bit different because it's more kind of and to check your alignment with a potential investor, and you have to rate what's important for you. No, so and this is different to the other form. It's not, there are no good and bad answers. is basically to understand what's important for the founding team. Now, it's important for you to be focused on your local market, or you are more focusing on a global opportunity, and this will help the investor understand if you are the right company, the right fit with them. It's not wrong or right. It's just that every company has a specific approach, and every investor has a specific approach, and both must be aligned. And I think that's everything that I wanted to show about fundingtrip.com and the fundiness and readiness tool that we have embedded into it. So I'm going to stop sharing now this, and I will share again the presentation, and I will hand over to Martin. 1 second, that I need to move. I need to find the window, and yeah, show this slide. Okay, Martin, you can continue whenever you want.
Great, thanks. Okay, so maybe quickly about me. So I'm based in the UK. I come from a technical background, so my background is actually in chemistry. I have a PhD in chemistry, but I also have finance expertise, and I'm a manager at Strata that focuses on clean tech and digital innovation, and finance for startups in those sectors. And like Araceli and David, I work on both public and private finance for those startups. In these last few minutes, I'm going to try and talk about a few practical things that you can do to strengthen your investment case right now, based on the advice that Araceli has already given and things you may have read on the internet. But hopefully these are actions that you can actually take today or in the next few weeks or few months to make your investment case much stronger, so that when you are speaking to investors, you're coming from a position of strength, and hopefully a position to negotiate a good valuation and a good amount of investment, a good ticket size. So next slide, please. So the one thing that we will keep coming back to, and that everyone is going to keep coming back to, is traction. This is depending on the stage of the company. It can mean different things, but it's almost always the most important thing. The investors are buying a piece of your company, you're selling a piece of your company, and they're doing that because they want to make money. They're not doing it as a charity. They're trying to make money, and they only make money if you make money. So what kind of traction you go for will depend on what the stage of your company is and what kind of investment you're asking for. And obviously it's a sliding scale. So at the bottom end of the scale, customer engagement can be as simple as having some conversations or interviews with potential customers, maybe getting some letters of support, or just having some kind of evidence of engagement, like an NDA. And this is really a bare minimum for a kind of pre-seed investment. Anything beyond pre-seed, you're going to need to be showing more than this. This is at the idea stage. Realistically, any kind of institutional investor or any serious angel investor is going to need more than this. This is a starting point. So the idea, if you're at that stage, is to try and convert that as soon as possible into something from that kind of middle box, the willingness to pay box. So the big step up is not just showing that customers will talk to you, but showing that they will give you money, or they are very likely to give you money to pay for the product that you've developed or you're developing. So kind of at the bottom end of that spectrum, you've got LOIs. If a customer signs a letter of intent that says that once the product is developed, they will purchase a set amount based on meeting certain conditions, that's a good starting point. Obviously, a big step up from that would be paid pilots. So if you're developing in collaboration with a customer, or if a customer is willing to pay for a pilot, that's a very large sign of a willingness to pay, a very good sign of a willingness to pay, because the customer is actually putting their money where their mouth is and actually spending money today. And of course, moving up from that, you have signed contracts or signed agreements, and in some cases, early adopter revenues. So this would be kind of seed stage investment, or maybe Series A, depending on the industry. And of course, the gold standard, especially for later stages, but also relevant at earlier stages, is to have some kind of recurring revenue. So MRR is monthly recurring revenue, or it could be annual recurring revenue. There I've said 10,000 euros plus. That's a little bit arbitrary, but some kind of repeatable, predictable revenue is the gold standard, and maybe MRR is more applicable to SaaS, but in other industries there are similar metrics you can use. And if you have recurring revenue, that means you can also look at metrics on growth or churn rates or other kind of unit economics that are relevant to your business. So you should be able to show data-backed early unit economics rather than kind of business model ideas and forecasted numbers that are based on nothing concrete. You will have real concrete numbers, real concrete recurring revenue. Of course, commercial traction and customer traction is the most important, but there is also technical traction. So if you can show technical validation, maybe in feasibility studies, grant-funded projects, or if you're working in deep tech, that could also be some kind of academic collaboration. Technical validation is still traction. It doesn't replace commercial traction, but it's still important. And of course, if you are looking to get the best valuation possible, then having other investors interested is always a plus. You can walk up the ladder a little bit if you have some investors interested at a lower valuation. You can leverage that when you're speaking to new investors and play on FOMO a little bit, fear of missing out. Next slide, please. So the next thing that I think you can actively work on from today is the team. So Araceli already talked about this quite a lot, but the key point here is, or there's a couple of key points. If you are a solo founder, think about, seriously consider bringing in a co-founder. You should be covering off that says technical expert, but it could also be product, depending on the industry. Business expert, which really means commercials, someone that is able to sell, they know the market well enough that they can go out into the market and sell. And then, of course, a domain expert, someone that knows the market really well, someone that has years of experience working in the industry that you're trying to enter. And if people are missing, then you don't necessarily need co-founders covering all of the bases. Like Araceli said, you can bring on advisors, which is something that's really easy to do, relatively easy to do at an early stage. Bring in advisors to fill the gaps, especially when it comes to the domain expertise. Bringing senior advisors that have long-standing experience in your market, that can be a real strength. And if you have gaps, identify the gaps, be transparent about it, talk to the investors about it, but make sure you have a really, really solid plan to fill that. Not a vague hiring strategy, but named people that you've had conversations with that are going to join the company under certain conditions and can fill those gaps. Next slide, please. So the third kind of action you can take now, which I think is a little bit simpler, is working on the business model from a financial perspective. And this depends again on the stage of the company. You might already have, the first one there is customer acquisition cost. If you don't have any customers, then you can only predict what the customer acquisition cost is. But be realistic. Look at, real marketing and advertising costs. What does it cost to hire a salesperson in your industry? Don't forget about important overheads. So the CAC, the customer acquisition cost, is the total expense to gain one new customer. And the flip side to that is the lifetime value. So what is the total value that customer will bring to you as a company? So that's the total projected revenue or net profit, depending on your metric, that a single customer will bring throughout the relationship. And the ratio between those two numbers is really important. So, of course, the higher the lifetime value to CAC ratio, the better. But if it's less than something like 2 or 3, then you don't really have a viable business. It should be at least 3. So if know your business model really well, be really prepared to answer questions on it. And if your business model is not working out, then you need to spend time developing it further. And I think that's something that you should do as early as possible. Yeah, ARR is the same as MRR, really. That's annual rather than monthly. But if you do have revenues, then make sure you have a real number for the annual recurring revenue that you can present to investors. Investors like that. And then the bottom three acronyms on this slide are looking at this from the other side of the table. So if you think about the mindset of an investor, they don't look at your company, or they're looking at your company as a financial investment. They have their own investors. Somebody is investing in the venture capital firm, for example, and that VC firm is then investing in a portfolio of startups. And they're promising their investors a specific return on investment over a specific time horizon. They have very specific goals that they need to meet to stay in business. Startups are more risky than publicly traded equity, so they want a return on investment that's higher than what they could get by investing in the stock market. So they have their own metrics they need to hit. And time and time again, investors have said that if you can speak their language, if you can go into a meeting understanding the metrics that they're looking for and talk about those metrics in relation to your business model and how you're meeting them, then that's a real plus. It makes it much, much easier for them if you can really show, based on this market data, these revenue projections, this hiring strategy, we can generate an IRR for your firm of X%, then that presents something that is really clear cut for investors, and they can really, talk to you in their language rather than you forcing them to talk to you in your language. And of course, the ROI and the multiples and IRR all relates to an exit strategy. So you can't present those numbers without having done your research on a likely and real exit strategy. And remember that investors will have seen dozens or hundreds of companies go through this kind of process before. So they will have an idea of what a realistic exit looks like. But you need to know what that looks like in your industry specifically. So look at similar companies that have exited recently, maybe not in exactly the same industry, but working in with a similar business model in a related industry or an industry that is for some reason comparable. And who are the potential acquirers in your market? Are there big players that you should be talking to now that might be interested in acquiring the company in 5 years? Because that's what actually matters to investors. What they actually care about is selling their shares at some point and returning money back to their investors. So make sure you have a really solid plan for that. And that can be a lot of paper-based research, a lot of online research, but then also going out and speaking to the big companies and finding out what it would take or what they're interested in, what they're looking for. Next slide, please. And then finally, before you speak to any investors, an important action you have to take is the capital deployment strategy. So sitting down and doing the maths. How much money do you need, and exactly what are you going to spend it on? How long is it going to last you in a realistic case where maybe you generate some revenues, you hire a lot of, the team that you really want, but also how long is it going to last you in a worst case where maybe you don't generate any revenues, where the hires are more expensive than you expect? How can you cut back, and how can you extend that runway to make sure you can still meet all of your milestones? When you're talking about things like personnel or property and equipment, make sure you've really thought about it. Do you have named hires? Are they revenue generating? What are the realistic hiring costs and overheads and salary costs? Is the property and equipment, does that need to be in-house, or can it be outsourced? What's better value for you as a company and for your investor? And are those investments, again, are they revenue generating, or is that still funding R&D? At what point does it switch to being revenue generated? And of course, the capital deployment should always be milestone based. So always linked to key outputs. And again, investors care about money. It should be focused on commercial and return on investment. It should not only be focused on R&D. Even if the next few years are R&D focused, what does it look like in 3 years or 5 years time? And of course, include realistic risks. Investors know what their risks are, and they want to know how you're overcoming them. So be transparent and talk openly about it. There's no need to hide anything. So that's all I wanted to say. I think there's four actions that you can actually take. You can start working on the team. You can constantly be working on traction. That should be the main goal, but also more paper-based work out what the capital deployment strategy is, and really try and nail down what the revenue model and return on investment to your investors is. That's it from me.
Thank you. Thank you very much, Martin. So I think we're gonna leave it here. Let me see. I cannot. Yeah. Okay, this is the last slide. Yeah, we're gonna leave it here. I think as a recap, we have seen what investors are looking for, how to increase or strengthen the funding readiness of a business, of a startup. I think we are seeing on a daily basis many startups that are going directly for investors, but they haven't done a thorough preparation of their business case, and they have very limited traction. So I think all these insights from Martin and Aracelia are very useful for early stage founders that are thinking of raising capital from investors. You have to really do your work, because this is a very competitive and hard market that you are entering in. Raising investment for an early stage startup with limited traction is not easy. It's very challenging at the moment. So I hope all this webinar has been useful. And see you in the next webinar. Thank you everyone. Bye bye.